Let me just. Hello. I wanted to just talk briefly about the last chapter on our government funds, and this actually doesn't cover governmental funds. It's these trust and agency funds, and it can be a fairly complicated chapter for students to master. Hopefully, at the end of the lecture here, this short video, you'll have a better understanding how to approach the chapter and what you need to master from that. Let me just point out first off that it's really important for you when you look through the material um, that you pay close attention to the first page and a half. The bottom of the first page, they talk about um, different types of transactions. So, the government can get money from either private individuals or other governments. And the theme in this whole chapter is the government is a custodian for other people's assets, and that's why they're used. But the discussion in the opening part of the chapter really talks completely about when the government receives funds and they can be used for a variety of purposes. And so it kind of goes back and looks at chapter 4 again, where we talked about special revenue funds and permanent funds. And so that's one of the things that can happen. You get funds from some source, and if it has a public purpose or a private purpose, and if you can spend all the money or only the earnings on the money, it affects the accounting. And so review that opening discussion carefully and kind of sort out, because what we're interested in this chapter is a situation where the government gets funds from typically another government, and it's going to use those funds, is trusted those funds just either to collect property taxes or as a part of an investment pool. All right, and so you want to be able to categorize when you're getting funds that's for a public purpose or private purpose, if that's going to be treated as special revenue or an agency arrangement. And if you can only spend the earnings on it, it's typically going to be a permanent fund if it's for a public purpose, the earnings that can be spent on a public purpose for the government's activities. So that's kind of the future activities is the definition there is other government's monies. And in this chapter, this last objective, uses for and characteristics of aging funds, the only thing that I want you to get out of this chapter, the retirement benefits is a very complicated area, as is the post-retirement other benefits like health insurance, health coverage. Read the chapter so you're aware of it, kind of just generally. But my primary focus here is when you account for commonly used agency funds like these investment trust pools and tax pools, because what happens typically is that there'll be multiple governments that'll have a right to tax property owned by citizens, and so instead of all the governments duplicating or triplicating the effort to send notices and collect payments and do the assessing, one government will do that. So in Fairbanks, for example, the North Star Borough handles that task, and so you don't get statements from different governments, not from the school district, not from the borough and the city. You just get one. And then when you pay that, the funds are distributed to those other governments that have overlapping jurisdiction. And so that's kind of the key theme. All right. The other one is when one of the governments operates an investment pool, and it's inexpensive. It takes qualified people, and you want to be able to utilize those high-paid salaries as well as you can. And so it's common for them to open it up to other local governments, and they can invest short-term, long-term, whatever the objectives are for each individual government, but they throw them in a common pot because there's economies of scale. And so that's what's happening there. So those are the two main activities. These tax pools and our tax funds and investment pools. And you want to understand the accounting for that. And one thing, when you work through the examples in the chapter, what you want to really pay attention to is that there's the agency fund is a separate entity by itself, so that's why it's covered in this discussion of funds. And a lot of the entries that are made, you have to pay attention. Are we making the entries in the example? Are they in the agency fund, or are they in the participant government's funds? And it's an important distinction because, like, when there's a fund that's going to administer the property taxes, a tax agency fund, they're going to send notices. They will never have revenues and expenses in that fund. Okay, none of these will. They have zero net assets or net worth, if you will. Assets exactly equal liabilities. So anything that's given to them or they collect is the property of the participating governments. So there's no fund balance here. Everything is a conduit. It goes in and out. And so if they collect income in an investment pool, it increases assets available, either cash or value securities, and there's an equal offset that's going to be the undistributed funds or the equity of the participant funds, the liability that shows the equity of the participating governments. So anyway, pay attention to the examples and see if, first off, are the journal entries you're looking at and trying to understand made in agency fund, or are they made on the participating government? Because you're going to see some of the same entries that we've done in Chapter 4 for property taxes and recording revenues from investments, but there's also going to be parallel entries being made in the agency fund when those activities are pooled. Okay. So, and that's the example that this discussion I told you to pay attention at the beginning of the chapter relates to this slide on agency funds, pension trust funds, private purpose, and investment trusts. And so these are all different activities. And again, the employment benefits is a very complicated area. It would be a whole semester class to really understanding all the thorough accounting, the measurements, and the reporting. So we're just there so you're kind of aware of it. Okay. And this is emphasize this point here. No fund net position exists. So all assets in an agency fund are offset liabilities in an equal amount. And so it makes the financial statements pretty simple because they're just going to be assets and liabilities. Very few. So here's the first example. This assessment debt service fund. So that's another area where assessments come up, and so this another area for agency funds, which I'm just going to cover because it's in the slide here, is that the government could undertake on behalf of the underlying property owners infrastructure improvements and other activities, special service responsibilities that the majority of those citizens agree to. And so in that case, the revenues that are collected and held for provisional citizens services like servicing debt for these infrastructure expansions, this is another form of agency because it's purely for the benefit of the citizens, and the government really doesn't have any claims on those assets. Here's an illustrative transaction, and this is for the property tax fund. And let's skip through this one. This is what I want to talk about. Tax agency fund. So this just shows a county official collects all property tax for property owned in the county. So these are all the different governments that have a claim on the tax base, right? And so they're all going to be collected by the county. The county has been designated as the government, local government is going to administer the property taxes. So it's in real life, each property has like a subsidiary ledger where it shows current assessed value, the current year's tax levy, and any payments towards that. And these are really aggregated up. And so it's not always as simplistic as was presented in the chapter, because we do know property by property basis what is owed and what has been paid. I just want to add that the issue becomes that or at least the accounting that's presented in the chapter is sound and reflects reality, because the overlapping jurisdictions by governments on if you're in the city of Fairbanks, you're going to pay school district tax, you're going to pay North Star Borough tax, and city of Fairbanks tax. And so the allocation of your common tax payment is exactly how it's done in the chapter. It's pro rata based on what's been received been paid to the underlying governments. And so this is just an example of where you've got a whole bunch of local governments and different mill rates. And it's funny, Fairbanks mill rate is pretty close to this. It varies from year to year, but around 20 mill rate, and that's per thousand. And this just shows the extension of those with applicable extensions. So, piece of property that's subject to all of those different local governments and special purpose entities would pay about $3,500 per year on the assessed valuation of 220,000. So now we go through these. I'm just going to go through the tax agency fund today. So here's the levy. So notice if you read the example, they're assuming no uncollectibles, because normally that would be netted out, and that's the way it was in Chapter 4. In reality, we do have that, but we're trying to keep it simpler for you to see how we do the same transaction only through an agency fund. And so the tax receivable for other funds and governments current, so we always have current versus delinquent, and then there's a corresponding liability due to other funds and governments. And that basically is a tax levy for all the underlying governments that have a claim on property. And here's the allocation of that, right? You see the breakout. The state has 10, county has 1.48, the school district has 5, city has 2.5, and other governments would aggregate to 366. So these are all in the agency fund, right? Highlight that agency fund here, and then the next one is agency fund. So we're getting payments. We're going to collect approximately half of that levy, the receivable. So cash comes in, we reduce the tax receivable. What you have to go through and look at an example is that there's going to be entries made at the time of the levy on the participant governments that's like what we did before. In other words, there's a tax receivable, and you're going to recognize revenue at that time. All right. The difference is that the individual governments aren't sending those notices and collecting the payment. It's being done by the agency fund, and then once the cash is collected, we'll distribute this pro rata. And so this slide here shows in the bottom the allocation of the funds collected, the cash of $4,734,000. This agency fee is there's an administrative fee that's typically charged 1%. I think our problems have 1%, 1.5%, 2%. It's not designed to make money, just to cover the cost of administering the burden of the agency fund, the tax agency fund. And so you notice the participating government here is the county. Okay, and let me just pause this and switch it over to the okay. I'm recording here. So this is our participating, the one that's running the agency fund. And notice they're not getting the deduction. What they're getting in that column, the collection fee, is this and this and this and this are charged to these other governments, right? So the state is getting they collected $5,000, and the fee is based at 1% on that. So they're being charged. So the net amount that's going to be paid to them is to the state is $4,950. Then you skip down, and these other governments, like here for the school district, the funds collected $2.5 million for them. Their fee is going to be this 1%, $25,300. So the net is going to be the $2,504,700. Anyway, all these fees are going to be kept by the county, and that's what the $39,940 is. All right, and so in the next slide we'll see this journal entry, but that's basically the math. Having trouble getting back over here. Okay, and so here's where this is kind of crappy, because all of a sudden we're in the school district, but here's the funds that were going to be received by the school district. They're getting cash for the net amount, right? The tax collections less the administrative fee, and that administrative fee that's their shares is $22,500. We'll just flip back up here. 20, yeah, there's a typo. This actually should be 25. So this should be 25,500. And the receivable that they have is $2,225,000. They recorded that concurrently when the tax agency fund did the tax levy, and they set up a receivable. So there's tandem receivables out there, and it shows it being paid. Next one, The county, which is administering the fund, okay, that's just the net cash they're getting. Notice they're getting the fee. They're not being deducted, so you're adding that on to the revenues, right? So there's a tax receivable that represents property taxes that were levied and now they're being paid, and then the revenue for the administrative fee, and that really just offsets the expenses that they're incurring. Okay, and that's really the whole thing. The book and example has all the slides. So the other one here is this investment pools, and we'll tackle that in a separate lecture because it'll take a little bit of time too. But it's once I think you figure out the logic here, it's not as complicated as the examples might make it seem. All right, well, I'm going to go ahead and sign off for today.